I think the older I get, I am beginning to appreciate ETFs and what it has to offer for the average retail investor. And by selecting specifically low-cost dividend growth ETFs, you can accumulate higher than average dividend yields and solid dividend growth without sacrificing the performance of the broad stock market performance. Hey guys, this is Nick with Nick Does DGI, and welcome back to my channel. In this video, I'll be going over 3 dividend growth ETFs to consider buying for your portfolio and has the potential to set yourself up for retirement. I hope you find some value out of this, and don't forget to hit that like button, so let's get into it. The first dividend growth ETF I would like to talk about is a Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. I've been seeing this ETF thrown around online, so I had to take a deeper look, and all I can say is that I am thoroughly impressed with what I see. The investment objective of SCHD is to track the total return of the Dow Jones U.S. Dividend 100 Index. Total net assets equal excess of $21 billion and was created on October of 2011. The expense ratio is attractively low at 0.06% and contains 102 holdings. The average price to earnings ratio is 21.27 with the average weighted market cap of just under $122 billion, a 31.59% return on equity, and a 5-year earnings growth of 9.38%. As of this time of recording, SCHD is trading around $75 and offers a 2.72% dividend yield. Dividends are paid quarterly every March, June, September, and December. And year-to-date, SCHD is up 19.57%, 51.02% over the past 1 year, and 90.39% over the past 5 years. And here are the top 10 holdings. You'll see blue chip dividend companies with widespread brand recognition such as Home Depot, Amgen, PepsiCo, Pfizer, and more that make up 41.14% of the portfolio. And you'll further see that this fund has a higher sector allocations to information technology at 20.8%, financials at 20.8%, consumer staples at 14.6%, and industrials at 14.3%. And when compared to the S&P 500 during the past 10 years, SCHD, shown here in blue, slightly trailed behind with a compounded annual growth rate of 15.23% to the market's 15.98%. That being said, this does not take into account the fact that SCHD has been growing its annual dividend payout at a fast rate of 12.2% over the past 5 years, ranging from a low of a 6.96% increase in 2018 to a whopping 19.79% increase in 2019. And despite the global pandemic, the fund's annual dividend was grown an additional 17.64% in 2020. With this kind of dividend growth, investors' yield on cost, decades from investment, will afford them the luxury to retire off of dividend income and can do so without liquidating the principal underlying holdings. An initial investment at the fund's inception in 2011 would be yielding 8.37% today. This, in my opinion, makes up for the slight underperformance to the broad market. The second dividend growth ETF to consider is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. Any ETF from Vanguard needs no introduction. I'm a huge fan of Jack Bogle and what he has contributed to the investing community. VIG seeks to track the performance of the NASDAQ U.S. Dividend Achievers Select Index. In other words, VIG passively tracks the performance of stocks of companies with a record of growing their dividends year over year, plain and simple. VIG was created into inception April of 2006 and contains 247 holdings with a likewise low expense ratio of 0.06%. The fund's total net assets is the largest of the 3 ETFs mentioned today at $67.2 billion. The average price to earnings ratio is 27.6% with an average weighted market cap of $151.3 billion. With a 22.3% return on equity and a 5 years earnings growth of 11.4%. As of this time of recording, VIG is trading around $152 and offers a 1.51% dividend yield. Dividends are paid quarterly every March, June, September, and December. And year-to-date, VIG is up 9.57%, 36.04% over the past 1 year, and 89.56% over the past 5 years. And here are the sector weightings as well as the top 10 holdings for VIG. Notice that compared to SCHD, VIG has a slightly higher exposure to industrials at 21.8%, consumer discretionary at 16.6%, and healthcare at 15.4%. Quality blue chip companies like JP Morgan, Microsoft, United Health Group, Procter & Gamble, and others in the top 10 make up 31.2% of the ETF. Compared to the S&P 500 over the past 10 years, VIG, shown here in blue, has slightly underperformed with a compounded annual growth rate of 13.18% to the market's 14.54%. As far as dividend growth goes, the 5-year dividend growth rate was 5.7%, with a 20.31% dividend increase in 2012, with a low of a minus 1.56% dividend cut in 2013. And during the 2020 pandemic, VIG has managed to increase its dividend by 7.62%. This translates to a growing yield on cost. Don't shy away from a low starting dividend yield in the 1%, for with continuous dividend growth increases, VIG's yield on cost, if purchased 10 years ago, would now be yielding 4.14% today. The third and last dividend growth ETF is the iShares Core Dividend Growth ETF, ticker symbol DGRO. DGRO offers a low-cost exposure to U.S. stocks focused on dividend growth and access to companies that have a history of sustained dividend growth, broadly diversified across industries. The fund was created June of 2014 and has total net assets in excess of $18.9 billion. The expense ratio is 0.08% with 391 holdings. And as of this time of recording, DGRO is trading around $50.52 and offers a 2.05% dividend yield. Dividends are paid quarterly every March, June, September, and December, and year-to-date, DGRO is up 12.72%, 39.98% over the past 1 year, and 88.72% over the past 5 years. The average price to earnings ratio is 25.39 and a historical annualized earnings growth rate of 13.17% since its 2014 inception. The largest 3 sector weightings are information technology at 20%, financials at 17.7%, and healthcare at 17.35%. Among the top 10 holdings are well-known blue chip companies such as Apple, Verizon, Procter & Gamble, Cisco, and others, making up 26.21% of the fund. Compared to the S&P 500 since the beginning of 2015, since this is a newer ETF than SCHD or VIG, DGRO, shown here in blue, slightly underperformed with a compounded annual growth rate of 13.17% to the market's 13.99%. DGRO's 5-year dividend growth rate was 10.77% with a 14.86% dividend increase in 2018, with a 1.44% dividend increase in 2014. And during the 2020 pandemic, DGRO managed to increase its dividend by 10.55%. And as far as DGRO's yield on cost, this ETF has only been around for just 7 years, and the historic yield on cost is already at 4.26%. A few more years of quality dividend increases will allow your yield on cost to hopefully grow past 10%. I hope that these 3 dividend growth ETFs made it onto your stock market shortlist that warrants further research and due diligence. To recap, all 3 of these ETFs offer expense ratios that are competitively low and offer both a starting yield and annual dividend growth rates that are higher than the S&P 500 and compounded year over year with dividends reinvested. Investing in a simple dividend growth ETF strategy will grow your passive dividend income in retirement. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. If you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on all the latest videos. The YouTube algorithm likes these sorts of engagements and helps my channel gets noticed. Until next time, take care.